There is something called last 200-day moving average in this Nifty.
Correct.
So we checked over the last 10 years, every time Nifty went below the 200-day moving average, which is considered a bad sign. It's considered
Just to explain it in simple words, 200-day moving average is the average of the last 200 days of price.
Yes, of price. So when that price goes below 200-day moving average, means you're in a negative zone right now. So we said whenever market goes below 200-day moving average, how has gold performed at that time? So 8 out of 10 times, gold has outperformed the Nifty. 2 times, both gold and Nifty has gone down. You can't do anything about that. Both have gone down. That time cash is king or FD is king at that point. But now I cannot come and say that FD is good or FD is bad. Because in today's market, FD is good. Gold is good. Tomorrow's market, FD won't be great. Right. So market is changing so dynamically. You cannot sit with the framework. And we do the same thing. We call it the fluid framework.
And how do I know what phase of the market is in? Because see, post-COVID, I remember a lot of people were hitting the siren saying that this is the end of the world, markets are going to crash. How could we possibly get out of this? We had probably one of the best bull runs of our lifetime.
Yeah.
Then after that, the war started, tariffs started. You are always, working in post-mortem as an average investor.
Yep.
How do I know it before it happens? Or how do I be one of the first ones to know? Let's say I see some leading indicators. I identify those leading indicators and I realize that, hey, this is going to happen. Let me now make these changes.
Yeah.
So what is that working model you have in your head to predict what phase of the market we are in so that I can properly do the sector allocation and actually get those returns that I want compared to the benchmark?
Okay, so I'll tell you a couple of things, right, from a retail investor standpoint. First things first, understand that you can never catch the top and never catch the bottom. This is a misconception. People think they can. Never you can do it. So it's okay to not know.
Even Warren Buffett can't.
Nobody can. Yeah. It's okay. You don't know. It's fine. It's absolutely okay. Number 2, let the chart tell you what is happening with the, let Nifty tell you what's happening in the market. You don't become an expert and say market will fall tomorrow. Let it fall. See, if I am let's say the bull run only, 2020 bull run, right? The market went up like crazy. Any stock you had invested gave around 100, 200, 300% returns. Then it fell around 20%. Even if you had done that and exited at this point, you would have still made money, right? So that's okay. Now, when there is a bull run, everyone knows there's a point of time where it is overvalued. I also knew it. Everyone knew it was overvalued. But market was saying, I don't care. So when market is saying, I don't care, who are you to become a over smart expert, right?
So when you mean overvalued, you mean the PE of the Nifty would have been about
stupid.
25 or about 30.
Everything stupid. All our fund managers were saying in September, every fund manager came and said, market is overvalued. Nobody believed them, right? People still were invested. Yeah. We believe it, but we were invested because we don't want to listen. And when the market breaks 200-day moving average is when people take everything seriously. But even if I just play from about 200, when it went about 200-day moving average in 2020.
In the upward direction.
Upward direction. I'll still make enough, no? In that perspective, I'll still make enough. So a lot of people get problematic here. Like they look at news, they look at 100 other things and they exit early. Let it ride, let it run. So we did that. We did the research with, let's say, some companies, right? It broke 200-day moving average upward. You buy at that point and you only sell when it breaks 200-day moving average later on in good periods. You make enough and more above the index also. So it is not, you don't have to overthink it.
So this is a momentum strategy.
This is a momentum strategy. Right now, no strategy is working. Only gold is in momentum right now. So right now we are back into finding companies at 25 PE, 30 PE. That worst case also it can't go down so much. Best case will be great. So now we have to change our strategy to stock picking, like quality. Instead of momentum, we have to go into quality. We can't use quant right now.
Just to summarize, so let's say before September happened, when the market corrected by I think around 25%.
Yes.
So what could I have done? What leading indicators could I have seen to know that a crash was coming?
Yeah. So you would never know a crash is coming. That's what I said. You will never know when it's up or when it's down. You'll never know. But I'll tell you a simple hack. If you do, you will save your portfolio a lot.
Okay.
The minute Nifty breaks 200-day moving average, go into at least 40-50% gold or liquid fund.
So when the Nifty goes up about 200-day moving average,
you're okay. You're invested.
Okay.
When it breaks that 200-day moving average,
the downward direction,
and nothing happens good below 200-day moving average. So I'll tell you, Jan 9th, Nifty broke 200-day moving average. 2025 Jan 9th, Nifty broke 200-day moving average. If you had just changed your portfolio from 100% equity, that 25% of your portfolio, instead of 100% equity, you do 50% equity, 25% gold, 25% cash. You would have beat every fund manager in India. And when did that come above the index again? It came only in May, June. That we came about 200-day moving average in May, June. Buy only after that. Go back into your 100% equity.
So this is how I actively manage from an asset allocation point of view.
Without overthinking it.
By just looking at the 200-day moving average.
Yeah.
If the 200-day moving average has been crossed in the upward direction,
You're invested.
You're invested.
Yeah.
When it comes down below the 200-day moving average in the downward direction, I will sell half, keep 50% equity, 25% gold, 25% FD.
You'll beat
I'll beat most fund managers.
most fund managers.
This we have back tested and checked.
Yes, I told you 8 out of 10 times gold has outperformed Nifty when it broke 200-day moving average. Only 2 times both gold and Nifty fell. But gold did not fall to that level like a Nifty would fall. Nifty fell 25%. Those 2 times gold would have fallen 7-8%. But your cash component, obviously cash means liquid case, right? You keep it in the liquid fund. That will give you 0.6% per month or 0.5% a month. 3-4 months correction is there. You make 3-4% on that. So if you really want to take very aggressive, just go full equity and full gold and full cash. If you really want to go, absolute.
So that is from an asset allocation point of view.
Glad you made it till here. If this gave you even one idea to improve your finances, send it to a friend. Helping them might just make you the smartest person in their group chat. And don't miss the full episode on Finance with Sharan. There's a lot more where this came from.